G'day expats and welcome to another episode of Expat Chat, episode 113 today. And as always, I'm joined with my mate who's coming from the floods over in Dubai, not the sandpit anymore.
No, the swimming pool.
Brett, that's right, mate. Brett Evans, who is the founding director of Atlas Wealth Group, as well as the managing director for us on the Europe, Middle East and Africa side. G'day, Brett. How you going, mate?
Mate, well, thanks. Well, thanks. And it's funny how the lead up to our last episode, which is back in March, we'd always say, oh, it's, weather's changing, a bit of rain here, and it's a very unseasonal time. And then, holy mackerel, did things change over the last month. So we had, and just for the folks out there to give everyone a bit of chronology. So we had floods in March, hence why, and just to explain where the gap's been with the time frame. So we had floods in March, and there was a cleanup from that. And then we had, that was during Ramadan, then we had the Eid break, and then we all went on holidays, spring break for the kids, and then came back into April, and then we had the flood, where we had about 250 mils of rain descend on us, which in a country that has no real topography, at least where the urban areas are anyway, we virtually all live in a floodplain. So cities like Abu Dhabi are fine because they live on an island. So as soon as the water goes up 20 centimetres, it just runs off into the ocean. The coastal areas of Dubai were okay because, once again, it runs off the ocean, but go inland, flood as attack. And when there's no riverine system or estuaries or anything to draw the water away, they have to manually pump it out with trucks. So, which to their credit, they've done a brilliant job. They, how many trillions of litres of water that had to move from Dubai would be phenomenal to actually know the numbers. But so unfortunately our place got wiped out. We had 4 feet of sewage and stormwater go through the place. So for the folks out there who talk about, hoarding and clutter and things that you should go through spring cleaning, go through a flood. It's amazing how the decision gets made for you. So you see stuff floating past you that you don't want anyway. So so now we're in that sort of state of trying to locate temporary accommodation, and while just keeping life normal for the kids. That's the interesting part. Is they're still going to school. My daughter's still doing her mock exams for GCSEs and everything, and so the world keeps turning and markets keep turning, and so it's funny how we're in this sort of 2-stage sort of lifestyle at the moment where we've got the property side and the work side sort of all going in different areas. So the folks out there, thank you for your patience. Sincerely appreciate it. But we are back on air. We do have sort of some modicum of normality resuming, so not fully yet, but we're getting there, and thank you for everyone's patience. But just realised we haven't introduced yourself, James. So for the folks out there who are new to the channel, the guy on this side, people can see me pointing on the video, to my right, your left, whichever way you look at it, is James Ridley. Is the managing director for the Australian office, good mate, business partner, and a specialist, very much so in the US space. So there's a lot of people now out there saying they're US financial planning experts. They're in a line behind you, James, because they joined the party well after, and most of them just copied your content, to be honest with you, and have been sort of regurgitating the same stuff since. So, but mate, let's get on to the episode 113. What are we going to talk about today?
No, we're gonna I suppose knock the head on a few things. We've got some great questions that have actually come through from our Facebook group. So quick shout out also to our Facebook group. Those that are members there, really appreciate you guys dropping the questions in there. That's the Australian Expat Financial Forum. If you're not part of it, jump in there. Get in there. There's some great things which are being talked about there at the moment. And we always do a bit of a monthly Q&A, and we've got some great questions which we'll jump into today. We've got some other questions which have actually come through on our podcast link, which is very separate to our Facebook group, which is great. And then lastly, I wanted to just talk about common things that we often see that come out from the Australian budget. So we do have the Australian budget. That's right. So budget's coming up very, very soon, 13th, 10 days. So we'll talk about that briefly. There's definitely one main change. We don't want to know where it sits. So we actually might get a really important update in just under 10 days now. So that's really exciting. So I thought, why don't we jump into it.
Yeah.
Brett, I might hand it back to you to do the quick little disclaimer.
Housekeeping, all the information that we're going to talk to you good folks today about should be treated as informational and educational purposes only. Do not consider this as personal advice. If you do need to get personal advice, reach out to specialists like Atlas.
Absolutely, man. Now listen, let's jump into it. I'm going to read out the first question that we have from our Facebook group as we kick things off. This is a great little question here from GB. I'd say that's probably maybe a nickname, but it's looking at it from a tax residency aspect when we're in Thailand. And I'm just going to paraphrase the question. It's about when we withdraw our Australian super as an account-based pension, it's being taxed by the Thai taxation authority, which is also the same for, say, the UK. And if there's any way that we can essentially avoid paying Thai tax or maybe tax to the HMRC on our Australian superannuation income stream. So, I mean, I'm happy to delve into this. Unfortunately, and I'll hand it over to you as well, Brett, but unfortunately, a lot of the double taxation agreements that do exist don't really have specific carve-outs for how, say, Australian super or a foreign pension should be taxed by that contracting state or the other contracting state. So a really good example for me is the US.
Yeah.
Australia will tax you on your US pensions. And if there's an advisor or an accountant out there saying, no, it shouldn't be the case, well, let me have a word to them. But you'll pay some tax on that to the ATO, absolutely. And unfortunately, the DTA that we have there with the US is very odd. Similar with the Thailand, I suppose, taxation authority there, where we unfortunately will pay tax locally in Thailand on our Australian superannuation scheme because, well, stream, I should say, because it is just seen as some sort of foreign income. And because super is tax-free in Australia, unfortunately, you do not have a foreign tax credit to take over to Thailand to use and use as an offset rule. It is the exact same with the UK. Unfortunately, the UK on income streams, so not lump sums, but income streams, is taxable by the HMRC. So if we're living in the UK, we're drawing out an account-based pension from our Australian super, we would need to declare that in our income tax return on the UK side and pay some tax on it. And there's no tax credit there that can be used because it's all tax-free on the Australian side. Brett, any other feedback to provide with that one?
Mate, France, Italy, Spain, they're all the same too. So, and essentially, as you say, there is no architecture or framework to provide you with a free kick. I think what's complicating this gentleman or lady, I'm not sure, their sex, but Thailand recently changed their rules where in the past you could live in Thailand, you could draw an Australian super account tax-free and get the best of both worlds. Australian super income stream, living in Thailand, cheap and easy, happy days. So that is what's coming about. So those in Thailand and other countries are now changing those rules. There's a couple of strategies you can employ. They're not easy to employ, but to me, commuting your super fund, so you take a drawdown as an Australian tax resident, you commute your pension account back to a accumulation account, you go overseas, you live on the money that you drew down as a lump sum to fund that, and then if you need to top up, you move back to Australia, become an Australian tax resident again, do another drawdown, commute the account back, and then off you go from there. So it's a pain.
Oh, yeah. Mechanics of that are probably going to be near impossible in the future with the changing tax residency rules. So it's a tough one. And I know there'd be a lot of retirees in Thailand which have moved over there purely for cost of living purposes. They can really stretch much more out of their retirement assets. And there's definitely some that are over there where based on their assets level, they're accessing the age pension in Australia at a reduced rate. This is all going to impact them. So it is punitive to that measure, those retirees living over there, but there's not really a way to, I suppose, get around it. It's just a case where you're going to have to pay the freight to the Thailand Taxation Authority or most other countries as well. So good question there from GB. There's a new question here from Katie. If you plan to buy an investment property in Australia for your child to live in during university, is there any tax risk associated with having a dependent student living in our property? Oh, good question.
I mean, I think there's a financial answer and a personal question. On the personal side, throwing parties and trashing the joint is the first thing that comes to my mind. And that's, I'm not speaking from experience, of course, wink, wink. But, that's a risk. But certainly from a financial perspective, I mean, of course, I mean, it's an asset in your name. The asset's not being held in your child's name. So therefore, capital gains tax at the non-resident marginal tax rate applies. I mean, and if it's in New South Wales or Victoria, look at those massive land tax bills coming through now. They are getting a monster. So, I've had this conversation quite a fair bit with clients who have been paying for college fees, and they're like, okay, maybe I should, buy a place for them to live in. And we've run the numbers, and it's actually cheaper just to go and rent a place for your kids.
Yeah. Yeah, I mean, the land tax is changing, and it is punitive. I mean, the asset in this situation, it is an investment property. Yep. So treat it as an investment property, because you're not renting it out in the open market. You're not renting it at all, to be honest. You're just letting your kids live there. The carrying cost of the property will add to, or the holding cost, I should say. So, council rates, land tax, if there's mortgage on it, interest, all those sort of things. Those holding costs will increase the cost base when you eventually sell it. But you got to remember, because you're owning this asset by the sounds of it as a non-resident, you're not going to be able to access the 50% CGT discount concession. So it's not really a tax efficient way to probably assist. It might be cheaper to have them boarding rather than having the property, and then, having, anywhere between $15,000 to $50,000 carrying costs. And then, what's the exit plan at the end? If it's not not the best sort of property for them to live in, if you sell it, there's going to be a bit of capital gains tax if you've owned it for maybe 5-10 years. But also you factor in your annual holding costs of that asset, which might have been 30 to 50,000, and it's only making a capital gain of 100,000. Well, you're out of pocket by a significant amount over that 5, 7, 10-year period. So maybe give that one a rethink. The other consideration is, if the new tax residency rules do get updated in the next 12 months, that's a financial connection, I should say. Plus, you've also said it's a dependent student, and that's another thing under family ties. So giving that a little bit more thought, depending on where you live in, Katie, as well, especially if you're in a tax-free zone, Middle East somewhere maybe.
I think also
but that's how it'd be treated.
Return on capital too. I mean, for the time, let's say they do a 3-year degree, you're getting zero rent on that property. And so you got money going out, nothing coming back in.
Yeah.
So whereas you might just be better off just, I said, getting a rental in their name, or putting them in college.
Yeah, absolutely. Absolutely. It's that's sort of a dead asset, that one. And it seems like there's actually a bit of feedback underneath that one in the group. Some are thinking about gifting cash to reduce tax exposure and other things, but it's an interesting one. Land tax in Victoria for an investment property. Is there any way around it? Not that I'm aware of. What about you, Brett?
No, resident, non-resident, everyone's getting stung. And so much so that Chairman Dan reduced the threshold down to 325 or 375,000. So pretty much covers every single property in Victoria, unless you got some little shack up in the wheat fields or something. I don't know. It's, to me, it's the government's way of saying, we're not taxing everyone, but they're taxing everyone by virtue of the threshold they've set.
That's right.
There's a lot of confusion as to, Victoria has those different layers. So there's the land tax, then there's the foreign citizen land tax, which sometimes expats think it applies to them. But if you go onto the Victorian government websites, you can see that that doesn't apply to you because you're an Australian citizen. And then you've got the absentee land tax as well too, if you leave the place vacant. Now, from what I can understand, and once again, we're not Victorian tax specialists, so don't take this as verbatim. And once again, this is general advice. But I have looked at it for a client, and from what I could see, even if you are an Australian citizen, the absentee land tax applies to you, which might also come back to, the first question. If you're not, providing any sort of, if you're saying it's invested property, but there's no contract, will that person be open to, absentee tax as well too? I don't know. There's a lot more work that people have to do rather than, oh, I'm just going to buy a little Freddie or little Jane, a little studio apartment to live in. It's finance. It matters. You need to do your homework.
Yeah, yeah, absolutely. And I mean, even down to when you're purchasing it, if you're purchasing it with a spouse that isn't a permanent resident of Australia, Australian citizen, remember, most states will charge you about 7% extra, I think the amount is, for the stamp duty when you're first investing in it. It can be, a massive amount. We just had it.
Yeah.
We just had a client of mine buy a property, South Australia. As part of our advice piece, we were just saying, listen, you're going to have to buy it in your own name and add your partner later once they have permanent residency. And the savings for that specific advice was over $35,000. So,
Yep.
so
Because she wasn't
it was
on the
well
list,
worth it.
Yeah.
That's right. Yeah. So, being mindful of that, absolutely. But yeah, land tax is a tricky one. There's not really a way you can get out of it. If it's permanent resident, if it's your permanent place of abode, your main residence, then yep, that'll be exempt. But most expats can't really cover off on that one because they're overseas. Yeah. Moving on to another question here. This is about a 401k, so I might take this one from Scott. Here is my problem. I'm trying to work through. I'm moving back to Australia soon at age 59 and a half. Should I leave my 401k in the US or cash it out and invest the money in Australia? I don't need the cash right now, but want to avoid any tax implications in future years. I've been working in the US on a visa, still an Australian citizen. I mean, really good question. 401ks, quick summary of how they're taxed in the US. 401k, all tax deferred, assuming no Roth component, made up of salary sacrifice contributions and then employer contributions through a matching scheme. Everything goes into an account slush fund. It's invested. When you start drawing down from it, if you're over 59 and a half, you will then pay your US marginal tax rate to the IRS on that because it's a tax deferred account.
Yep.
And then typically, most 401k platforms will withhold a flat rate of anywhere between 20 to 30%. And then you lodge a non-resident alien tax return at the end of the year to either pay more tax or get a tax credit. More likely than not a tax credit. On the Australian side, they are taxed like a foreign investment trust. So the contributions you've made and that your employers kicked in as well, they're actually tax-free in the eyes of the ATO. They make up what we call the corpus. Corpus is just the original capital. The other component is the investment earnings, the growth of the account. That will be taxable. So that portion of your income stream, or say a lump sum withdrawal, portion of that's going to be reportable in your individual tax return. You'll get a prorated foreign tax credit for any tax that goes to the IRS first, but our tax rates are more punitive than the US's federal tax rates. So it can result in us having to pay a bit more to the ATO, unfortunately. And then winding out is a question, should I cash it out now or invest the money and invest it in money back in Australia? I mean, without knowing Scott's full balance, it is really, really hard to give you, that's right, to give an actual determination there. I mean, I like to see 401ks, IRAs, much like a super fund, treat it for what it is. I think you've said you're coming back, but you're not necessarily retiring. Treat it as a retirement account and another income supplement that you can parcel with your Australian super in the future. And that essentially will mean that you're reducing your overall tax leakage to the ATO by withdrawing out, say, a standard amount each month when you're fully retired, setting up an income stream from it, rather than cashing out maybe 100 or 200 or 300,000 US and getting absolutely smashed by US tax. And I have a little bit there on the ATO side as well. So you need to be careful of that. And that's my feedback on that one. What about you, Brett?
It comes back to episode, and I was just trying to look up what it was last year, but timing is everything. I think it was, anyway, it's there. If you go back and look at the catalogue of, here we go, episode 102, Importance of Timing, back in October last year. And it's the same thing. Sometimes it makes sense to keep something in its place, whether it's a UK pension, US 401k. If there's an intention to return back to those countries, you can sort of tap into these things as an income source. And for others, not so. If you're back to Australia for good, then your life becomes a bit more complicated because obviously you have double taxation of those accounts, but also to the management of those accounts becomes more complicated because of time zones. I don't know, with folks who have never been to the US, but I know for a fact that those who live in the US are going to understand exactly what I'm about to say right now. Dealing with US financial institutions overseas is next to impossible. They don't have international numbers. They don't want, as soon as you say, I live overseas, I can't talk to you, whether that's right or wrong. And people have so much grief. I've had clients actually fly back to the US just to attend to financial matters, just because they found it impossible to deal with from Australia. So there's that side as well too. In terms of, everyone's different in terms of how they want things to work, but it will become more complicated if you go back to Australia, as well as potentially, as you say, with double taxing by the ATO, more expensive.
Yeah, absolutely. It's a tough one, navigating that space. But yeah, cashing out the lump sum, very dangerous. You need to seek some advice if you are going to do that. That was a really good question, actually. Well done, Scott. Another question here from Britton. So Britton submitted this via our podcast feedback link, which is great. This is a good question, and it's about covering off on when you're part year tax resident and how it all operates when you're expatriating or repatriating. So wanting to know, how does it actually work? When you come back to Australia, if you're arriving, say, in the first 6 months of a financial year, versus if you're arriving in the last 6 months of that financial year, are you a tax resident for the full year? So it might be best, I'll paraphrase the question soon, but probably just a quick summary of when you're leaving Australia, what happens, and when you're arriving in Australia, what happens.
Essentially, unlike other countries, it's the date of arrival, date of departure, and then your assessment based on the tax rules at the time. People forget that the non-residency rules are also residency rules in reverse. So when you become a non-resident, the resides, domicile 183, that's all you're focused on. Same thing in reverse back to Australia. So when you move back to Australia, the resides has to play. Where do you live? Where do you work? Where do you play? The domicile, where do your behaviours map? That of an Australian resident, that of a foreign resident, and last of all, 183. So when you're coming back into the country, it's like you're a blank piece of paper and your boots on the ground. And from that date onwards, you're a tax resident as long as you meet those tests going forward. Updating the electoral roll to put yourself back on, changing your bank account details to local addresses, putting little Johnny into a school, those sort of things that map to that of being a resident. But also, too, your assets are treated at the same time frame. So unlike the US, for example, where there are good and bad times to enter the US from a taxing point of view, if you entered the wrong time, your previous, that calendar year's income earned overseas could be assessable, whereas Australia doesn't work like that. It's virtually that date of arrival, boots on the ground, the clock starts ticking.
That's right. Yeah, and I mean, when we look at, and this is going to actually address a question that Britton's phrased to us about, how's income treated when you're a partial tax year resident. So when an accountant is actually completing your Australian tax returns, there's actually a section within the tax return which they can state what dates you are a resident or a non-resident. So it'll say, it'll literally have the question under the tax 3 threshold tests, like what dates were you a tax resident. Normal people that are in Australia, it's just obviously the full financial year, but it might put the date in which 1st of July 2023 to the 30th of September 2023. Cool. So you're a tax resident for 3 months. What that does is it actually pro-ratas a lot of the tax rates within that tax return. So if you're putting in your wage income, if you're putting in your dividends, rental income, it'll have an impact of pro-rating a lot of that income. And then it automatically work out what's taxed and what's not taxed. Just because you've been a tax resident for 3 months, it doesn't mean that you're entitled to the full tax-free threshold. They actually have to pro-rata the tax-free threshold based on your period that you're in Australia. So you don't get the full 18,200. Because technically, I guess the ATO would see that as being unfair because they should be able to tax you more. So when we look at different income streams, dividends, interest, those sort of things, it is pro-rated based on your time within Australia. And there's even times where if your income situation is quite messy, and what I mean by messy is a lot of different sources, they'll actually prorate the income or prorata the income based on your tax residency for the first 3 months. That's tax return A. And then they'll do another tax return for the period that you're a non-resident for the rest of the year. So that's all captured under non-resident rate. So if you're receiving things like dividends that are fully franked, you don't actually need to report them in that portion of the income. Sorry, that was a lot. I need to get it out. The interest income, the interest income for the remainder of the 9 months, 10%. withholding tax. That's normal. And it gets prorated. There's not really a way that you can play two tax systems against each other, because that would mean that you're trying to be a non-resident for a short period here and then, only a resident in this year for a short period and then a non-resident here. If you were doing that regularly, year to year to year, I guarantee you, ATO is going, what's going on here? This person's a resident over here for 6 months, but then a non-resident for 9 months, but then a resident over here. Let's dig a little deeper and see what's going on. It'd be a really quick red flag. An auditor would pick that up very quickly and go, this is very strange, because when we layer the current tax residency rules over that person's situation, no one can cut ties and recommence ties that quickly. So that's probably the biggest risk there, Britain, when you're trying to play the system. It just won't work. You'll get audited. More than likely, you'll either be treated as a tax resident in both countries for that period, than a non-resident, I would say. Yeah, that's right. Yeah. So really good question there. We might pause on the questions and just wrap up now with a bit of feedback on the budget, what we often see coming out of the budget.
Mate, there's a lot of things, and there can be a lot and a little depending on the attitude or the aptitude of the government incumbent at the time. I think it's people probably don't realise that the next round of elections is due, can be called as early as October this year, as late as May next year. So this is a pre-election budget. Now, is there going to be things in there that are sweeteners? Don't know. We know what we do know, that super contribution limits are changing after 1 July, which is good. I think the big thing that everyone's talking about is the tax residency rules. Now, we did a submission. The world did a submission. Everyone did a submission. September last year. Haven't heard boo from Canberra. We know that Treasury is working on this stuff. We know that for a fact. So it's not like it's stopped. It's just in the background. Given the fact that they've got an election coming up, do they want to push this through with the hope of getting it off the plate so they can focus on the election and get those things done? Or do they put it on the back burner for either themselves to pick up next year if they get re-elected, or the Libs come in and do their bit? So 13th of May is going to be a big one. Then we also have the sweeteners for the local residents. Not really too much for expats, mind you.
No.
It's a strange world we live in. We're never surprised by some of the stuff that we do see in these budgets. But just to keep everyone informed, we're going to be having seminars and webinars for this. So on the 15th and 16th of don't quote me on the dates. It's straight after the budget in that week. We'll be doing the Dubai and Abu Dhabi seminars in person. We'll deep dive into the budget, pull them apart, and also doing an update on property, equity, and currency markets. And then the following week will be webinars, which once again, I'll put everything in the links down below so people can register for those events. Let us know. Jump on board, send us questions in advance. It's going to be a good time. I'd say there's a 65-70% chance that we will see an update with respect to the tax residency rules. I think there's enough work that's been done now that it can actually happen.
Absolutely. I 100% agree, and I look forward to seeing what comes out. Should be good.
All the links down below, guys. Sorry to wrap it up. There's a lot going on with James and I trying to play catch up after the last 2 months of craziness. But we're back on air weekly now. So we'll look forward to seeing you on episode 115, I think it is. Or 114.
Sounds good. So, thanks for tuning in, guys.
Thanks, guys. Take care.